Test, test, test. Yeah. All right. So I think we should be good. My computer potentially is potentially faster today because I was able to close 100 different tabs, which is like a third of what I have open because there's so much research that needs to be done on a daily basis and lots of things need to be kept in mind. I'm pretty sure lots of you guys have the same situation. Let me just make sure that everything is good. Okay. So yeah, we need to do something about starting right away because the first 1-2 minutes is just about this whole checking the sound thing. So I'm not sure how to fix it. If you have any idea how to make sure I can start knowing that everything is working without like actually testing it, please let me know. Maybe I can test it before starting the stream because that way, yeah, it's again kind of slow. Because that way, maybe we can save on time. Okay. Let me just wait a little bit more. I apologize. Perfect. Everything's working. Beautiful. Okay. So, there are two things we need to cover today specifically. The first one is the proposal number 10, just to give it a bit more feedback on what is happening. And number two is continue on the governance. There are lots of research we're doing, and it seems like we are innovating. And I would like to just tell everybody, kind of put you guys, keep you guys in the loop regarding what exactly is being happening, what exactly is being changed. Okay. So on the side of the proposal, so proposal number 10, it's about more ETC confirmations. So how many confirmations should we have on the side of the bridge in to make sure that the transfer is safe? And this proposal has been published in the Wales yesterday. Let's please all vote on this. The deadline is Sunday, and once the deadline is, once the proposal is over, we will go ahead and integrate the bridge in. Now, the bridge in is sufficiently easy to integrate. What's not easy about it is just the variables. Pretty much similar to many other features that we have, such as governance, right? Such as on the Ghost DAO side, on the Ghost Chain side, PGhost, etc. So all of those, for the most part, require just some custom tweaking. Now, they don't require it, but it would be nice to have it. But again, they don't require it, right? And lots of those things can be changed down the road. In any case, so what can we say about confirmations? So confirmations are needed in order to not get the double spend. The whole innovation of blockchain by Satoshi, because there have been lots of well, not lots of, but there have been some attempts to create a digital currency before, prior to Bitcoin. I think one of them was called eCash and stuff like that. So those projects were never able to solve the problem of the double spend in a decentralized way. Double spend meaning I send you the money, you give me the whatever, the proceeds, like whatever, you give me the goods or services, and then I'm able to revert the transaction. In that case, that's a double spend, essentially just happened. So the reason why all the other, for the most part, the reason why all the other attempts to get to a decentralized currencies failed, because that problem has not been resolved. And Satoshi resolved it with Bitcoin, and obviously all the other blockchains resolved it as well. So right, so essentially the Bitcoin resolved it by something called the longest chain. So the longest chain is the longest chain of blocks. That at the end of the day wins. However, it's a bug and it's also a feature, right? So the feature is it's a decentralized kind of decision-making voting mechanism. The longest chain means that, let's assume you have block 1, block 2, block 3, and I'm an attacker. I have block 1, block 2, block 3. I have alternative blocks. So then the question is, who will be able to maintain the longest chain? So if I'm able to kind of overtake all the other validator power, mining power, and just kind of proceed with block 4, block 5, block 6, block 7, etc. in continuity, and then the majority of validators will agree on my chain, then that's the longest chain attack. And for the most part, that attack occurs when 51% of the validators are compromised or controlled. So therefore, this attack or vector for the double spend is directly related to the hashing power of a given protocol when it comes down to proof of work. Now, for proof of stake, because there's a stake in place, it's possible to introduce deterministic consensus mechanisms. And those are a lot more flexible, but again, that's the bug and the feature, right? So, kind of, it's potentially kind of, it's, well, it has its, like, for the most part, how the proof of stake is resolved, and it is you introduce the stake. Now, what's the problem with the stake is? The problem with the stake is this. If I have 100 Casper, I was able to get it on day one, right, when the protocol launched. I can pretty much just hodl, right? I just, kind of set and forget, and then I'll still hold 100 Casper. And that's the problem with this kind of generational wealth, right? So this is the problem with the unfairness in the world, where somebody is born with a lot, somebody is born with little, and while the opportunities may be the same, but the starting conditions are very different. And because the starting conditions are very different, then kind of the set of opportunities, therefore, is kind of unfairly distributed, right? So proof of stake, therefore, has a similar issue. Any proof of stake model, including Ghost, where whoever got the stake earlier, for example, potentially got it at a much lower valuation, at much lower prices, and the proof of stake is then could be reused for participation in the staking mechanism. Staking, like, meaning earning, well, not passive, but like kind of active yield in exchange for validating the network. While in proof of work, Satoshi can have 1 million bitcoins. Doesn't matter, right? Like, you have 1 million bitcoins, my friend. However, with 1 million bitcoin, you still need to run the rig. You still need to run the rig, the mining rig. You still need to validate. So essentially, your historical achievements in proof of work are not impacting anything in the future. In proof of work, your previous achievements are directly correlated to the ones in the future. Not only that, but they're also limiting new entrants. For example, Cardano, right? With the Ghost as well, right? Like, as the supply is becoming more inelastic, as we discussed before, due to inelasticity, it becomes more and more difficult to get additional stake of Casper down the road because it becomes more expensive, right? And the reason why it becomes more expensive because there's another inelastic mechanism of the curve on the DEX, for example, right? And stuff only trades on the DEX, like Ghost, Casper, eCasper, Casper only trade, well, eCasper and potentially Casper also only trades on the DEX, right? So because of those inelasticity measures, it kind of definitely creates some unfairness, right? Like, right? So, and that's like for all of us to decide, like, kind of, does it make sense to stick with proof of stake or not? And we definitely had some considerations, not a lot, but some considerations to potentially switch the Ghost consensus mechanism from proof of stake down to proof of work. Okay. So the proof of work, the biggest kind of solution for how the blocks get added to the blockchain is via one sec. Let me just mute everything. Is via the longest chain. So the longest chain is a solution, but it's also a bug. What's the bug? The bug is if the hashing power of the protocol is quite low, then the attack vector becomes quite cheap. And if the attack vector is quite cheap, then you need to, as a user, react accordingly. So confirmations. When we say confirmations, how many confirmations do we need on the Ethereum Classic? Well, that's essentially the same as how many blocks do we need to wait for after the transaction took place to make sure that the probability of this transaction reverting back is as low as possible. Now, in probabilistic blockchains, there's no such thing as guarantee. Meaning, on Bitcoin, there's no such thing as a guarantee. On Ethereum Classic, which is also proof of work, there's no such thing as guarantee, meaning that nothing is guaranteed. So this kind of mythical description of a blockchain that blockchains are immutable, it's really not correct. Blockchains are not really immutable. blockchains are immutable contingent upon the validator set decides not to screw you over. So kind of now blockchain is decentralized. What does it mean? What's the difference? Well, the stuff, your whatever, can be significantly compromised, your funds, by the bank, by a central authority. Now, who will be in charge of compromising you? Well, it's going to be, the board of directors, kind of the top officers in that specific banking organization, and potentially the government. So it's like a very, very limited kind of source of people who can completely compromise your holdings in the bank. Now, what can we say about say the blockchain Bitcoin? Well, in the Bitcoin sense, it's a decentralized set of validators who can compromise your holdings. Now it sucks. I get it. It really does suck. But at least you can yourself become a validator, and if you're not if you kind of understand what's happening, I don't want to say if you're not like a sheep, but if you understand what's happening, you would probably be running, a couple of validators who probably be encouraging your friends to run it as well, right? So the only protection for you really on proof of work is to run your own validator node and ensure that all the other validator nodes are not screwing you over. Now, of course, there's some business kind of protection, like XRP. It kind of is famous for pitching that protection as a philosophical protection. Well, I can just run a ledger. I can store the state of my ledger, and then if I know that ledger is correct, and if somebody compromised this ledger by reverting my transaction, I report to the world, hey, listen, please, this ledger has been compromised. Please listen to me. Question is, who will actually listen to you, and who will give a shit about your, 0.5 XRP being stolen by JP Morgan, right? Who cares, right? So Bitcoin doesn't believe in this bullshit. No, it's the longest chain thing. So since it's not immutable, there are no guarantees. Then what are the kind of, as the litmus test, what do other not blockchains, what do exchanges, central exchanges, treat as an adequate quantity of confirmations required to make sure the transaction will revert? So in case of Ethereum here, ETC, previous confirmations was 20,000 blocks. Now confirmation is a block, so it's a 13-second instance, right? 12 to 13. So let me calculate right now. So when we're talking about 20,000 blocks, 1 second, 20,000 blocks times 13 seconds divided by 36. So that is 72 hours, which is about 3 days. Now they switched it down to 3,000 confirmations. 3,000 confirmations is significantly less, but still quite a lot. It's 10 to 11 hours, right? That an exchange will need to wait to ensure that the transaction is safe. So I send the transaction on Ethereum Classic. It takes 13 seconds, therefore, to get added to the block. Within pretty much a couple of blocks, you can be more or less sure that the transaction got reflected in another person's wallet, in this case in Coinbase's wallet. But then Coinbase will still wait for another 3,000 confirmations before they can process your request. Why? Well, we're going to answer this question. Now, Bitflyer, that's another exchange apparently, so they still use 20,000 confirmations, did not change that number. Okay, now Kraken. So here we can look at confirmation processing times. There are a bunch of blockchains here. So for example, Bitcoin, I think it's 2 blocks, right? So let's see. Bitcoin, where is this? Lightning, Bitcoin, yeah, boom. So 3 confirmations, they do 45 minutes. Okay, so 15 minutes per block. That's what they're estimating. So bunch of rules here. Now let's get to Ethereum Classic. Now Ethereum Classic here is 2,880 confirmations, which is about 720 minutes, which is about 12 hours. So pretty freaking lengthy. Now compare that to Ethereum, for example, with proof of stake, which is 30 confirmations, 6 minutes. Still not instant, right? So when we say that stuff gets settled instant, that's another myth. It doesn't get settled instant. It gets settled never. For deterministic consensus protocols such as Ghost, such as Polkadot, anything substrate based, as long as they're using Grandpa finalization module, Palette, the finalization is actually deterministic. It's for sure. It will happen after 2 to 3 blocks. It's a very different technology. It's novel. Gavin Wood is a genius, or the whole Polkadot team is a genius, right? Substrate team is a genius, therefore. So uh, it's possible. So within 2 to 3 seconds, 2 to 3 blocks, which is each block is 6 to 8 seconds. So take it 8 seconds per block at most, and 3 blocks, that's 24 seconds. So within 24 seconds, not instant, but within 24 seconds, your transaction is finalized for good. Okay. In Ethereum case, it takes 30 confirmations, but it's really not true. In Ethereum case, so like I'm not sure what they're thinking about, but this thing is incorrect. In reality, Ethereum proof of stake will take about 64 blocks. Let's do this calculation really quickly. So 64 blocks multiplied by 13 seconds divided by 60. So that's about 14 minutes. And that's what we have on BridgeN. So for the Ethereum, we have 69 blocks. Now, why does Kraken take risk? Well, because even with 30 confirmations, like they're not stupid. Like BridgeN is looking for 69 confirmations. This guy's looking for 30 confirmations, still quite a lot. So they estimated the probability that within 30 confirmations, which is almost an epoch, epoch I believe is 32 confirmations, 32 blocks, Ethereum, like it's going to be significantly difficult to revert stuff. And most likely what's happening is, like this information is kind of false. If you are sending your $100, right, 30 confirmations is more than enough. If you're sending like $10,000, 30 confirmations is more than enough. However, if you let's assume send like $1 million, it will not be reflected within 30 confirmations. They'll still take 64 confirmations. They just won't tell you. Now, it's good for an exchange to minimize this number because most deposits are average in size. And if the lower the deposit, the lower number of confirmations you need. Why? Confirmations needed. It's just an indication of the cost of an attack. So if a hacker will attack a network, well, in this case, exchange, Kraken, and revert one of these transactions, they'll have to spend, let's assume, $100,000 in order to get $100. So it just doesn't make sense for an attacker. So therefore, it's just like a business type of protection where a reasonable hacker will not be spending X on the attack unless they can get more than X on that specific attack. However, if it's an unreasonable hacker who just wants to hack for the sake of hacking, that may not be the case. Meaning that the attacker, like essentially, like these protections are not really protections. Like nothing really will save you if an attacker wants to like spend unlimited resources to revert $100 transactions. So here we just vouching for the common sense of an attacker, and everybody's just vouching for that. So it's a game theoretical type of situation. Now, any transactions can still be reverted. For them, not every, but almost every transaction can still be reverted if an attacker has unlimited, like actually unlimited resources, like trillions of dollars on an attack. But again, the hacker will probably not do this because it just doesn't make sense. And that's exactly kind of what I would like to point out, that for the most part, there's no such thing as immutability. We just trust in the goodness of the validators. Like essentially those who are just holding, like buying and holding, like, yeah, if you guys holding it, like, you know, I mean, congratulations, but like you're really putting yourself at risk anyways. Like if you're storing your keys at the exchange, like it's even worse. But even if you're storing your keys at your own like wallet, a cold wallet, like Trezor or whatever, Ledger, or just a native core wallet, like Cool People, you're still running a risk. If you're not maintaining the network, you're still running the risk that the stuff will get sour. Now, even if you're running the network, just one node out of say 10,000, you're not helping much. The idea is to be an active, proactive, significant contributor to any network that you are running. In that case, you are significantly maximizing your chances that your holdings will not be stolen or compromised, and not stolen by you revealing your private key, but stolen by the whole kind of infrastructure of the blockchain. So essentially, kind of the idea of the blockchain is this, and that has been the idea. Many of us forgot about it, but that's the idea. You must protect your holdings. If you have holdings on the blockchain, you have to protect your holdings. You have to. Now, if you're not doing that, I mean, that's on you. Yeah, like that's on you, and that's on your IQ level. And that's exactly like we shouldn't be forgetting it. Okay, so what can be said about Ethereum Classic? So it seems like the average here is like this is 2880, this is 3000, this is like way too much, 20,000. That's potentially over the border. So if you take, say, the average of say 30,000 blocks, that's going to be 30. 1 second, let me just calculate it. So that's going to be at 13 seconds per block. We're looking at roughly 11 hours. So therefore, I'm a user. I go to Ghost Bridge in. I'm like, okay, I want to bridge Ethereum Classic. How much time do I need to wait? Well, you'll need to wait 11 hours. Like, it's a reality. Now, before the bridge can be processed. So now the biggest question is, does it mean that bridging sucks? Does it mean that Ghost sucks? And the answer is, well, if you think that, you just don't understand anything I just said for the last half hour, right? So, thing is, when like any exchange, right? Like essentially any transfer on Ethereum Classic is going to take time because Ethereum Classic, while it's a great Web3 blockchain, it does not have enough hashing rate to minimize it. So we're like, okay, so let's dive deeper into Ethereum, the Ethereum, right? Not Ethereum Classic, but Ethereum. Let's call it mainnet. So mainnet Ethereum. So mainnet will be Ethereum, and Ethereum Classic is Ethereum Classic, just to differentiate. So what happens to the mainnet? And we kind of decided to do a little bit of research of like, okay, but mainnet at some point in time back in the day was a proof of work as well. So did it also take 20,000 confirmations for that? And so check it out. So here, wait, is it which link is that? Or maybe I don't have it open. Or maybe I should also, 1 second. Is it this one? Wait, I just saw it. 1 second. Yeah. Yeah, so check this out. So kind of yes, kind of yes and kind of no. So this is Ethereum proof of work. Now, I think that's a fork of Ethereum. Right? That's not like the Ethereum, right? That's Ethereum proof of work. So somebody has conducted an analysis here. This as of 2023, August. So not that far ago. So what I'm trying to say is like prices here were not that much different from what we see today. It was not like Ethereum at like 1 cent and Bitcoin is like $1,000. So these prices were already pretty good. So check this out. So Bitcoin is just 2 blocks. Litecoin 48 blocks. Those 2 hours longer. Bitcoin Cash 17 hours. Why? Why Bitcoin Cash is 17 hours while Bitcoin is just 20 minutes? Ethereum Classic the same 11 hours that we have been vouching for. Zcash 40 hours, okay. Ethereum Proof of Work is like 90 hours. Again, that's not the Ethereum. I think that's a fork of Ethereum, which is called Ethereum Proof of Work. So why Ethereum is like similar, 23,000 blocks, and we kind of see these numbers here as well, 20,000 blocks. Like why? So turns out, we were trying to find the formula. Like, we were trying to find like there's got to be a code base specific formula that would tell us how to calculate the delay needed, the number of confirmations needed. Turns out there's no such thing. It's just purely business consideration, and the business consideration that I told you about, which is the attack has to cost less than what you're going to get from this attack. Only then you will be only then the hacker, a reasonable common sense hacker, will be attacking the network. How does it impact anything? Well, as you can see, Bitcoin Cash is pretty much a fork of Bitcoin. So the reality is this longest chain, because these are all proof of work blockchains. All these proof of work blockchains rely on the concept of the longest chain. So therefore, the higher the hashing rate, the more expensive it is to maintain the longest chain attack on the network. And the reason why Bitcoin is just 20 minutes and Bitcoin Cash is 17 hours is not because Bitcoin code base is superior to Bitcoin Cash code base, or Litecoin code base is like so much inferior to Bitcoin, and that's why Litecoin is 2 hours. No. It's all just due to the hashing rate. So if Bitcoin Cash tomorrow matches the hash power of Bitcoin, this will also be just 20 minutes. Same thing. Nothing different. Same thing we can say about, say, Ethereum Classic. If the hash rate of Ethereum Classic tomorrow goes up, then this number here, 11 hours, will likely drop. Now, why? Why will it likely drop? So, first of all, is our consideration even correct? Because again, like, we're all kind of learning this on the go as well. So these, like, most of these, like, for example, most of these articles, so this one is Ethereum, right? Like, talking about proof of stake consensus mechanism, how they are kind of more or less sharding. So let's read this article, like, let's read this paragraph here. which matches the same consideration that there's no potentially formula for identifying the confirmation. Like there's no right answer. It's just a field type of situation based on the business case, meaning the attack cost versus attack results. So further efficiency gains, they're talking about proof of stake, but same consideration, made by creating super committees, right? Super committees, say 125,000 randomly selected validators per slot, right? So this is like kind of like a huge shard of all the validators. So there's 10 million stakers on Ethereum, hypothetically, of which let's randomly select 125,000. Only these validators get to vote on a block, and therefore only this subset of validators decide whether the block is finalized. Whether this is a good idea or not comes down to how expensive the community would prefer a successful attack on Ethereum to be. So same consideration they have. This is because instead of requiring 2/3 of the total staked Ether, an attacker could finalize a dishonest block with 2/3 of the staked Ether in that super committee. So therefore, the larger the committee, the more expensive the attack. This is still an active area of research, but it seems plausible that for validator sets sufficiently large to require super committees in the first place, the cost of attacking one of those subcommittees will be extremely high. So if it's 125,000, randomly selected validators per slot, 2/3, which is 2/3 times 125,000, that's 32, because it's 32 Ethereum per validator, you get 2.6 million Ethereum coins. So it's not $2.6 million, it's 2.6 million of Ethereum coins. That's going to be an attack. So they've done some preliminary polls on that same subject, so meaning the Ethereum community at large agrees with this consideration for the confirmations, and the poll said 65,000 to 97,000 per super committee, which is a little bit less than 125,000, but it's still pretty much the same. And the community is okay with 1 to 2 million in Ethereum coins, not $1 to $2 million, 1 to 2 million in Ethereum coins, right? Which is Ethereum right now is like 3,000, so that's going to be like $3 billion to $6 billion, right? That's the cost of the attack on the network that the community is okay with. And so therefore, like even the selection of this shard is dependent upon this kind of business problem, right? As opposed to a technical problem. Now, Ethereum Classic, it's very difficult to find stuff, right? Like on these confirmations, but Ethereum Classic does something similar, right? So they say the cost per block is the reward per block by the current ETC market price. So that's the assumption. They say, like, let me one step back. As blocks cost a lot of computational power and electricity to produce, in ETC it's currently around $38.40 per block every 13 seconds. Then the latest block may be easier to revert by dishonest actors. But to revert all the blocks or delete or change transactions, it would require redoing all the blocks on the chain all over again, longest chain, making it extremely costly for the attackers. So here we say like the cost per block is reward per block by the current ETC market price. ETC is paying 2.56 Ethereum ETC per block. The market price is $15. Therefore, the cost is this, right? So therefore, like whatever the cost of so to summarize, you have a block reward every single 13 seconds, which is in this case was 2.556. This article was written 2023, also like quite recently, like 2-3 years ago. So today it probably, I think it drops by 20% every year or so. So maybe today it's 2 ETC per block. So at times the price, and we can get the $38.40. That's the attack on the given block. Now, why is that a good number as an attack? Well, if I am a validator, I would like to allocate my capital correctly. So I can buy stocks, I can buy bonds, I can buy a business, I can buy a cab and become a taxi driver, I can buy a truck, I don't know, become a truck driver, I can buy a farm, or I can buy a mining rig. So for me, therefore, the market rate of my revenue, therefore the cost, is the same as revenue. So like now, it doesn't mean that I'll spend $38.40 to mine it, because otherwise I wouldn't mine it. However, this assumption says that my rate of return is market level. So let's assume that I actually spent $38 in order to get $38.40. So I buy rigs and electricity and human resource costs and rent, whatever, to buy allocate my mining rigs. So I am simply like spending $38 in order to get $38.40. Okay, cool. So I'm earning 40 cents, which is roughly a percent. So what this assumption is arguing for is that this 1% you make it per block, that is going to be your market level return. So if you're gonna go and invest it in this, in the bank, you put $30 and deposit, you'll make maybe higher, but maybe there's more risk, right? Or if you buy the gold, maybe you're gonna double your money. Like if you bought gold like last year, maybe you double your money, but that's just this last year. With the risk-adjusted return is actually kind of the same. So it's the argument that the return is the same. Therefore, they argue that the cost is just the same as the cost. The cost to mine a block is the same as the market rate. That's an assumption. It's not true, but that's an assumption, and it's not a bad assumption. Okay, and then they just simply just say, okay, one day that's equal to this number of blocks, and therefore, like to maintain an attack on Ethereum Classic for one day at these prices, it would cost $250,000, and then for a year it would cost $93 million. And then they say, okay, cool. So how many confirmations as a user you should wait for? And they say, well, listen, it really is pro rata based on the amount. So if you want to transfer $1,000, right? You just divide this by whatever, by $38.40, and you get 26 blocks. If you want to transfer $5,000, the number of confirmations is higher. So if you want to transfer $1 million, it's 26,000 blocks, which is 3 days. Roughly 3 days as we calculated earlier, maybe 4 days. The argument here is if you are transferring like a larger quantity in dollar terms, maybe it makes sense for you to divide your transactions into small quantities and just send multiple transactions. Maybe that's going to be faster. So don't be a whale, like be decentralized, be distributed. Now, what is the solution for this problem? Like, I want to try, like, we were told that, listen, like, it costs the same, like, it costs the same, like, I transfer $1 billion in Bitcoin. It takes like 2 blocks. I transfer, $4 quadrillion of Bitcoin. It also kind of, same number of confirmations. Well, true for Bitcoin, because Bitcoin's hashing power is insane. It's very, very high. Not the same with all the other blockchains, because Bitcoin is the winner of the network effect, of the first mover advantage, right? So it was the first mover and got all the freaking hash rate in the world. Now, all the other carbon copies, unless they have some significant value add, they won't attract that much hash rate, and therefore they're struggling. I remember talking to miners, professional miners, with like rigs and rigs and rigs, like thousands of rigs, about 6 years ago, and I'm like, hey, listen, like, don't know much about mining. Tell me, what's profitable? Like, do you mine anything else outside of Bitcoin? And the answer was no. We only mine Bitcoin, maybe Ethereum, no altcoins. There's no profit on altcoins. So professionals, for the most part, don't run this stuff. Who run this stuff is service providers who just to juice the stats, right? They're not doing this for the profit of mining, kind of like making money off these blocks. They actually, like, typically, Anchor, for example, reached out to us, ANKR, and I think the cost was $4,000 per month per one node, or from $4,000 to $10,000 per month for one node. So you can check out your favorites of Solana, quote favorites, Solana, XRP, and all the others. See how many corporate enterprise miner runners there are, and you can estimate that how much the foundation is paying them to maintain the nodes, because clearly they're the only ones who can do that. Okay, so now the question is this: like, does it make sense for us to, like, what is our number? What shall be our number? Because the price of Ethereum Classic is pretty much the same. Like, so it was $15 now. I think it's $12 to $13. The rewards is pretty much the same. So per block is pretty much the same. So how many blocks should we be waiting for? And maybe the answer is somewhere here, 2 to 5,000 blocks. Now, again, there's no right answer. Like, we can just say, screw that, let's just wait 26 blocks, because most transactions will be within $1,000, right? But that's for every single user independently to decide how much to wait. Now, there are some suggestions for us to be kind of deciding, like, changing the number of confirmations based on the quantity of being breached, like maybe kind of have this on the code base. But it could potentially be, to some extent, it could potentially be gameable, right? Like, it creates like additional attack vectors, and maybe the best way is just to have a reasonable quantity of confirmations to be weighted, right? And then just put a massive disclaimer, hey, listen, like, if you're transferring more than this quantity, maybe you should either divide your amount into multiple transfers, or just be okay with the risk that the stuff will be reverted potentially. Now, have these transactions been actually reverted on Ethereum Classic? Yes, they have been. Back in 2021, a series of 51% attacks kind of happened on the network, resulting in about $5 million worth of damages overall. So that took place. Okay, so it's like 51% attacks actually took place. So it's a real issue. So when we say for the ghost thing, hey, listen, like be careful. Like if you're not running enough nodes, like you need to be aware that uh, somebody can can kick in the butt, like right, like if there's a huge clan arising on the ghost chain, they can rewrite all the bounds. That's a 51% attack back. That's a real thing. Like we're not bullshitting. That's a real freaking thing. So kind of I'm vouching for 30,000 confirmations out of infinite, right? Now, how much time will that will take? That will take about 11 hours. So the user will have to wait 11 hours before the bridge validators can take this transaction and start kind of processing it. That creates a problem. So one of the problems is this. So like, check it out. Like, do you realize that like this set here? So 13 hours, it means it's within a day. So 11 hours, that's within a day. But that's definitely not within a given epoch, which is 4 hours. Now, not only that, but that could also be within a different era, right? So 11 hours means that the era begins, like, for example, our era will end in about 5 hours, right? So if I'm looking at this set right now, like I say, okay, 71 validators, which is a pretty shitty number. Yeah, you got, oh my goodness. Yeah, you guys need to fix your shit, whoever is validating here. But 71%, not a big number. But I'm like, okay, fine. Like, I'll still be able to transfer. Bridge stability is 53%, by the way. Oh my goodness, that's fucked up. Critical risk. Yeah, so, but let's assume I'm like, you know what? Screw it. I'll still be bridging. Okay, so you're still bridging. Thing is, you bridging into this set of validators. But since you need to wait for 11 hours, the transaction will just be waiting for 11 hours without being processed. And then only in the next era the transaction will be processed after 11 hours has passed. So therefore, maybe this actually does have to go because this is not applicable for Ethereum Classic. Now, what other blockchains may have similar long delays? I don't think anybody really will have outside of Ethereum Classic. That's like an edge case because Bitcoin will have 2 blocks, so 20 minutes. Ethereum, the mainnet Ethereum is just 15 minutes. Pulse will probably be something similar. Also probably 15 minutes, maybe like an hour, right? We need to look into it, right? But like Tron will also be faster. So like all these others will be like faster than 13 hours, right? So this is something for us to figure out from perspective of, do we really need to kind of play this out on the UI? Do we need to have some custom treatment of Ethereum Classic? And my answer is no, we shouldn't. We should potentially just move this all away from the bridge end, have this one panel left, and move this all to the Ghostlight. And that's where, if you want to get additional info, please check it out there. Okay. So maybe that's like, I have some other links to potentially go over, but maybe let's pause here on the proposal 10. Now, do I feel like going over the governance? Okay, maybe. Let me quickly show you some updates there, and maybe call it a day because it's too much information for you guys, anyways. Okay, so last time we discussed the governance method, right? And on the governance side, it seems like we have some updates. We have some user interfaces that we're changing back and forth. So we'll share them with you soon. But we finished on why do we need to innovate last call. And the idea was we have these functions, and lots of these, like specifically those 3 are operational in nature. They will be called like, well, supposed to be daily, right? And then the question is, how do we arrange this? So we discussed Polkadot governance, where Polkadot has a 2-set governance, proposal and referendum. So depending on the proposal stage, let's say proposal supermajority, which is like everybody said yes unanimously. In this case, the negative bias will play into effect for the referendum, for the actual decision making, and vice versa. If proposal stage only had a simple majority, like about 50%, um, uh, then the positive bias will strive, which is something we'll share in a second. So, how does these, like, what does it mean, the positive bias, etc.? So let me just quickly share with you. Go back to this, and maybe after this we'll call it a day. So here, so the positive bias. So this blue line is what Polkadot has as a positive bias, right? So let me just like highlight. Okay, so 0 to 1 on the vertical axis, we have the majority. How many people need to vote specifically for? Now on the horizontal axis, from 0 to 1, we are looking for the quorum. So how many people actually voted? So as you can see, as the quorum is increasing, the majority required is dropping. And vice versa. As the quorum is diminishing, the majority required is very high. So for example, at this rate here, so we're looking at roughly 20%. So 20% of people came and voted. 51% will not be enough. It has to be 84% of people need to vote yes in order for the referendum to go through. So the idea for us is to take this curve and implement it for our governance. In that case, we won't have a fixed quorum required, but we'll have kind of a very flexible one. Problem is this: if a malicious guy comes in here with, let's assume, 10% of quorum, he or she will need to get 91% of majority vote, which is easy, right? Because they just say, hey, we just obviously all vote yes with our stake. And then we won't necessarily have enough time to react. So the suggestion is maybe to introduce this curve instead, the green curve. How is it going to be different? It's going to be the same curve, except for there's going to be a minimum quorum required of 10%. So 10% quorum needs to be reached. Only then the votes will start counting. So the curve goes exactly the same. So it goes from here down to here. So this is something we asked in Wales. Please comment. We may need to introduce some type of proposal for that as well in the coming weeks, maybe next week, for us to make that decision. Or maybe we don't need this curve, period. So that's one of the considerations, like one of the things that we are looking at to innovate, because that way we are more or less kind of resolving the problem of the fixed quorum. Now, it still exists here at 10%. Now, one thing about this quorum, or any quorum, is people need to vote, right? Like, the quorum is a percentage of all ghosts in circulation. So the more ghosts we have, the more people need to vote. Meaning that those people who just want to get ghosts and set and forget, they'll be actually be detrimental to the whole governance. The reason why they will be detrimental to the governance is because, well, the 10% of quorum, if that's not achieved, the DAO is stuck from the governance perspective. So we either need to get more ghosts at a higher price, right, and overthrow the oldest ones. So there's some thoughts about, and I don't think we're going to be implementing them, but there's some thoughts to make the DAO more like flexible by introducing the ghost staking. I don't think we'll be able to do this. I don't think we'll be launching it like for another year. Maybe we will, but I really doubt it unless we like be able to come up with something super fast. But my idea specifically is, let's assume we have 100 ghosts in circulation on Ghost DAO Ethereum, and of those 100, 90 are inactive and 10 are active. In that case, those who are active will be receiving some type of double staking, and those who are inactive will be receiving nothing. So this is going to be like an unsubstantiated inflation of Ghost, purely in favor of those who vote versus those who don't vote. And ideally, we punish those who don't vote. I'm not sure how to do it. So we kind of, the idea is to either punish the ones who don't vote in favor of those who vote. Question is how to do it, because kind of, we cannot just take Ghost from them. So maybe it's going to be some negative rebase. So I don't know. This is definitely something to to look at. Because in that case, if you're a passive holder, well, screw you. Yeah, because like if you and by the way, last thing before we end, there's finally a utility for sghost. So eghost, and we knew that sghost is needed, like we just couldn't articulate it. So eghost, obviously, that's the entry, that's the price discovery mechanism and utility mechanism on the DEX. Okay, these are the two functions. As far as ghost, that's a governance token and a bridging token. That's clear. Why do we need sghost? You need sghost if you want to be staking your eghost at a competitive rate. At the same time, you're not participating in the governance, so you're not screwing the governance. So if you don't want to be screwed, just go and hold your stuff in sghost. But if you are okay to vote, because voting is a very active thing. You need to spend gas fee to vote. You need to understand what the fuck's happening. Like it's a pretty active thing, and we need to potentially punish against passive holders of Ghost. Okay. On this note, let's end. Thank you so much for those who watched. I think that was a pretty productive and interesting call. See you guys next week. Have a good one. Bye bye.